April was a challenging month for both growth and defensive assets. Investor sentiment continues to be driven by central banks and economic data. US inflation numbers and the weaker GDP numbers led to concerns that the world's largest economy will not be cutting interest rates as quickly as previously hoped. The latest inflation prints have caused a deviation in interest rate expectations across the developed world. The US saw inflation creep higher to 3.5%, with utility and housing costs remaining higher than expected. Couple this with weaker GDP numbers and it's easy to surmise that the world's largest economy will not be cutting interest rates as early as expected. It was a different story, however, in the UK, where inflation fell to its lowest level in 2.5 years, driven by a slowdown in food price increases. Eurozone inflation data in April remained flat at just above 2% year on year, with core services and inflation both slowing. This means the markets are more confident of a rate decrease this year from the European Central Bank and the Bank of England when compared to the US Federal Reserve. The former is signalling for a cut in June. First quarter earnings in the US saw companies generally beat modest expectations. However, given valuations, any companies that missed their estimates saw their share prices treated harshly. Elsewhere, commodities performed well over the month on the back of tensions in the Middle East and the broader positive economic picture. Commodities also helped emerging markets perform better than developed markets. China also rebounded from its recent lows. Looking at factor performance, the value factor performed the best over the month, although still ended lower. In comparison, growth and quality reversed some of their gains from the first quarter of the year. Turning to the defensive assets, concerns on the resumption of higher for longer interest rate policies from central banks, particularly the US Federal Reserve, continue to drive near-term fixed interest pricing. In summary, 5 consecutive positive months came to an end for global growth assets. As we move through the second quarter of the year, we will now be watching the correlation between equities and bonds closely. As markets try to balance the economic growth with the direction of interest rates, we're poised for an interesting second quarter.